11 stocks, yes, 11 stocks that I'm planning on buying in the month of October of 2022. Now, for the folks that have been rocking with me for many, many years, you might remember 3 stocks I'm buying addition. Well, yes, inflation hit all things this year, okay, including my stocks list, because now it's 11 stocks at this point in time. In all seriousness, by the way, thank you so much for everybody for joining me as always. In all seriousness, the reason it's so many dang stocks is because the market has fallen so much. There's so many deals now emerged in the stock market. It's ridiculous. And I haven't been in this much of a buying spree in relation to so many stocks at one time since December of 2018, but this is even better than that in terms of somebody like myself that has a longer term outlook at these stocks and just seeing like deals everywhere. I mean, if this market keeps going this way, I think by the time it ends, every single stock will be a buy for me. At this point in time, obviously the Nasdaq's been absolutely devastated this year. Over 33% it's been hit. In relation to all these stocks I'm sharing with you here today, these all, in my opinion, will double up or more over the next 3 years. And I am going to share one of these stocks is the, in my opinion, the stock that I see the most reward potential being in the entire stock market in terms of upside over the coming years. One particular stock, like there's nothing I know of in the stock market, and I know of a lot of stocks, let's put it that way, that has as much upside as that particular stock that I'll be sharing with you guys in this video as well. So yeah, hope you guys enjoy this as always. I appreciate each and every one of you for joining me for today's video. Make sure to subscribe to the channel if you're not, and also if you're looking to join my private stock group and get access to the Discord chat where you can chat with all the members in there, including myself. We're always talking about all the different stocks that are popular in there. Also, get access to our private group investor report and get access to all the course curriculums. If you want access to all of that, check out the pinned comment to apply to join us inside the private stock group. Alrighty, guys, let's get into this. The first stock up here is Meta. Meta has my attention in a massive way right now, okay? This stock has been absolutely devastated. It's down about 60% year to date. It's trading at an 11p ratio now at this point in time, in a market cap in the $300 billion range. Now, if you ever told me this stock would get to this valuation, I'd been like, what? Like, there's a pretty low probability of that, but it has happened. And in relation to Meta, like, what am I getting for buying this company? I'm getting the Facebook platform, I'm getting Instagram, I'm getting WhatsApp, and I'm getting the metaverse opportunity, right? And Messenger as well, which is, you know, if we're thinking about 4 of the most popular apps in the world, Messenger, WhatsApp, IG, and Facebook, that's them. Absolutely incredible, the scale. There's no scale you'll get in any company in the world that is up to Meta's scale, okay? And the metaverse opportunity is so misunderstood by Wall Street right now, and people just don't even get that and understand like how big metaverse is going to be. Like, that's going to be ridiculous. That's a little further down the road. In terms of monetization, you know, Instagram obviously is going to continue to be a big monetization avenue for them, and Instagram Reels, which is really starting to take off. WhatsApp is going to be the next big, you know, let's call it multi-year lever for this company to pull in terms of big monetization there. And FB is still continues to just be a, you know, if you're going to advertise as a business, here's a deal. Here's an easy way to think about this, okay? If you run a business, just about any business, and you are going to spend any money on ads, you have to start the conversation with Meta and Facebook and Instagram. That's where it always starts, man. And then everything comes after that. Everything else. And, you know, I know so many people that run so many different businesses, so many industries. It's just like, if you're going to spend money as an advertiser, you're going there. You're going to get the biggest bang for your buck. And then you might consider TikTok and Snapchat and Google and everything else after that. But in terms of where you're going to get the most bang for your buck, it's still this company right in front of you. And that's a fact. And so there's no competition when it comes to that, okay? And that matters in a meaningful way. Now, in terms of this company, taking a huge step back in EPS in 2022, expected to get to a more profitable state in 2023, which I believe is going to happen. As far as revenue estimates, you know, basically they threw out any revenue growth opportunity for this company this year. But next year, expected to get back to double-digit growth once again, which I definitely expect. The reason, you know, basically the company grew much faster than it should have during Rona, right? Everybody's forced to be home. Obviously, if you think about just like the need for like physical products went insane. Everybody was advertising like crazy on obviously Facebook. So all that was an extra push that it messed up the company's growth rates. And so it made the company grow much faster in the short term, right? But then it devastates numbers this year. Instead of being just a kind of consistent growth company, right? The growth went insane. Now you get a year of no growth, and then you get 2023 of, let's call it slower growth. And before that, FB was just a consistent kind of, let's call it 18 to 25% type growth company. But they went through a kind of a huge expansion cycle. And but now the company's just trading at ridiculous P metrics, forward P metrics, everything across the board. It's got a top 5 best balance sheet in the world and a straight profit machine. So yeah, Meta, absolutely love that one. That's why that's the first stock of all these bunch, okay? Stock number 2 up here that I'm buying in the month of October will be Shopify stock. So Shopify, oh my gosh, you want to talk about a stock that's been obliterated. Shopify, down over 80% year to date. The way I look at Shopify, it reminds me a lot of Amazon, the tech bubble, just they're in a better position than Amazon was when Amazon had to go through the tech bubble time. But Amazon peaked to trough in the tech bubble, went down over 90%. I don't see Shopify doing quite that bad. They have gone down about 84%, 85% peak to trough when it comes to Shopify. They won't quite, in my opinion, get to that 90% range because they're just in a much stronger position than Amazon was when they had to go through the tech bubble. Shopify is just a much bigger company at this stage of the game than Amazon was back in 2000, for instance. So everything on this company, when you talk about stock prices down 80+% year to date, every valuation metric you want to throw at this has come down massively. And this is a type of stock that people want no piece of in the current market. And as soon as risk on goes again, which, it's a debate on when that's happening, but as soon as risk on, this is one of the top stocks people will flood back to. And in my opinion, this is one of the companies that, if you think of like what company has that, $500 billion, if not $1 trillion opportunity for themselves, it is Shopify in the e-commerce space, and they'll continue to expand their business. Okay. Now, when it comes to Shopify, if they didn't want to spend so aggressively, they could easily make this into a much more profitable company on the bottom line if they choose to go that route, right? But in terms of Shop, this is a growth story. And I understand right now in this market, no one wants growth stocks, but this is still a growth story. Expect to have 20% plus growth this year, 20% plus next year. Shopify is just one of the strongest, bigger growth companies you're going to find out there. Next year, expect to do over $9 billion of revenue. And, when you talk about these sorts of numbers, and if this company can keep putting up this 20% plus growth rates, and, then they're at 11 billion, and then they're at, 15 billion and 20 billion, and the numbers start to scale very nicely. And so that's why in the short term, as much as the market wants companies to focus on profitability, for a company like Shopify, honestly, they need to just keep the pedal to the metal. The market's going to come back to Shopify, okay? There's a great analogy I always remember in football. If you're rushing, let's call it a running quarterback, you don't want to go past them. As a lineman, for instance, as a defensive lineman, let them come back to you. And they will do that. And with Shopify, they need to just stay the course because the market's coming back to that company. It will 100% come back to that company. It's just a debate. Is it next week, next month, 3 months, 6 months, 9 months, 12 months? That's the whole debate, right? But the market's coming flooding back to Shopify, when it comes to stock market. And obviously their business is just going to continue to tear it up. So they just got to stay the course. Don't lose a ton of money in the short term. Keep your losses at a minimum if you're going to lose money, or maybe eke out small profits on the bottom line, and just continue to grow that beast because the opportunity there with Shopify is absolutely insane, okay? Stock number 3 of these 11 stocks up here is the Chef. You knew this one had to make the list, okay? So 2022 has been all about store growth for the company and SKU growth for the company, and that's where their focus really needs to be. Now, the market wants to take that attention away from store growth, product growth in stores and things like that because of the way market views like only profitability right now, because we're in scary times, and scary times, basically, if you're a growth company, you get thrown out. We just looked at Shopify's down 80+% year to date. The Chef is down 67, 68%. 10% year to date. No one wants those pieces of those type of stocks, but the Chef is doing exactly what they needed to do. Now in 2023, this becomes a company that will be a company around much improving margins, much improving cash flow and profitability in general, which is going to be huge for the stock price of this company, because everybody's looked at it and they're like, okay, yeah, they're growing, their brand's growing, they're getting bigger and bigger, people like their products, they keep coming back, the revenues are going up, the store expansion's going up, great. Market shares, great, velocities are great, cool. They're losing a ton of money. Their margins are horrible. And so therefore, no one really wants to own that sort of stock. Well, I do, and maybe a few other people do out there, but most people are like, nope, don't want that in this sort of market. And if this was a market of 18 months ago, these sorts of stocks were obviously the trend. Yeah, 18 months ago seems like a long time ago, because these are not the trend right now in terms of, people wanting to be in these sorts of stocks in this sort of market, right? But when it comes to this company, like, why are they going to make such epic strides in regards to profitability? And they'll likely lose money in 23, but it's going to be a much smaller amount. It's not even going to be compared to their past losses. So the reason is right now they're actually going up on price on their products, which is something they need to do. The problem, the reason the Chef kind of got screwed in regards to why didn't they go up in price sooner? Here's the deal. They had just entered retailers. As a new company entering retailers, it's a little sketch if as soon as you hit retailers, you go up in price right away. It's not like what you do, and it's not like the Chef is Coca-Cola and Pepsi that has 10 years, 20 years, 50 years of, relationships with these retailers and things like that. So they had to wait a little bit, and they had to kind of swallow that pill, which hurts in the short term, but ultimately it's the right decision to make over the long term. And but anyways, now that's happening. Their price increases are going through, and will continue to over the next quarter or so. So that's going to help their profitability. Transportation cost is going down massive, and this matters in two meaningful ways for the Chef. The first reason is basically they ship product overseas, basically raw product from Italy over to the United States. The second part is transportation of their, freezer goods around the United States, that all those rates have come down considerably when it comes to trucking rates. So that's really good for the company. And also, as this company scales and gets bigger, like everything they're going to do is just get smarter and smarter and smarter. They'll find ways to have cost synergies here, save money. They just had cold storage recently. They got automation starting. I mean, there's so many little things that end up adding up to a lot as you get to become a bigger and bigger company with more scale, and you just start to get smarter about everything you do, okay? Now, in terms of this company, it's still a revenue growth company. The real question is, when it comes to Chef, is how much do they want to push that revenue growth? Because I think they could push it to whatever they really want to push it at based upon their velocities and their sell-through. But the question is, does a Chef want to grow revenue for revenue's sake, or do they want to be in a situation where, let's say, they're only pushing their most profitable products or something like that, right? And I think that's absolutely something the company's going to have to consider. So I can see revenue growth anywhere between 20% on the low end to 30% on the high end for the company in 2023. And it really depends on, do they want to take a bigger loss, or do they want to take a smaller loss? And I think that's really what it comes down to for the Chef, at least in terms of 2023. Stock's gotten absolutely obliterated. I think it's a great value as a long-term investor like myself. No doubt it comes with risk, because it is a money-losing company in this sort of market, right? And so that's my opinion on the Chef. Okay, stock number 4 of these 11 stocks is Oatley, which will be Goatly someday. Okay, so Oatley is a stock that's been hammered. It's in the $2 range right now. It's down 68% roughly year to date, and this is the premier player in the oat milk space, which is, if you're thinking about an industry that's just going to grow massively over the next decade, oat milk is a pretty safe bet. Let's just put it that way. Cow milk is on the decline and will continue to be for the next, let's just call it 2 decades essentially. And oat milk will continue to be on the rise. And, I shifted my family from cow milk to oat milk, basically actually very shortly before I actually bought into Oatley stock. And, basically what it takes you from is, let's say you're a family, I have a pretty big family, so we might have bought traditionally 5 gallons of cow milk a week, right? And now instead of buying 5 gallons of cow milk a week, we buy 7 or 8 containers of Oatley milk now at this point in time. And that's a big shift, and that's a big dollar amount that used to be spent on cow milk each week that now is spent on Oatley milk each week, right? And so this is something that's going to not just play out, over the next year or two. This is something that's playing out over the next decade or two, and they have the premier name in this space when it comes to oat milk, and their product is so superior to the other products on the market. There's a clear taste difference between Oatley's products and how much better they are than versus like the competition, things like that. Like I know Starbucks had a shift from Oatley essentially to let's call it a generic company that provides oat milk. And customers were literally complaining about it because it changes the taste. It literally changes the entire taste. And there's some oat milks that are so bad. The Dutch Bros, for my Bros fans out there, Dutch Bros use the worst oat milk in the world. This stuff is awful. I tried to get an oat milk drink there one day. Oh my goodness, okay? So Oatley has the superior brand and product in that space by a mile, okay? Now, when it comes to this company, they're going to make good strides on their profitability as well in 23. I think they're going to be actually much more profitable than what analysts have for the numbers here. I think much more profitable. Here's the deal. I don't think anybody's even accounted for the fact that oats have tanked over the past, let's call it 3 to 6 months. And I don't know if that's going to fix itself anytime soon, and I hope it doesn't. So oats are way more affordable, and that's the main, other than water, that's the main product that goes into Oatley. So when oats went insane as far as oat prices go, that made Oatley's margins and profitability, awful. There's just no hope, right? And so, we're talking about oat prices are down 40, 50% in a pretty short amount of time, and could be going down a lot more here. Okay, transportation costs coming down for the company, and the company's scaling up a lot of their facilities now and have scaled them in 2022. And as with scale comes a lot of cost synergies. And so I think they're actually going to be much more profitable than analysts actually have there as a 37-cent loss. I think they're going to do much better than that. As far as the company is expected to cross over $1 billion of revenue next year. So Oatley, I really like that one. I like the management team, and I just think they're going to make tremendous progress on their bottom line and their margins over the next few quarters, and I think the stocks will end up being rewarded, okay? Stock number 5 of these 11 stocks is Palantir, PLTR. So Palantir is at the cross sections of data and artificial intelligence, which is going to help governments and businesses make much better decisions for, their interests, let's call it that. Now, the company in the last quarter had a very hated, basically, earnings report. And the reason this is essentially their government business wasn't as strong and their European business was weak. Well, Europe's in a real mess right now in terms of their economy and everything that's going on there. Secondly, sometimes government contracts, it's not like it's Palantir's fault that a government contract can go a quarter or two late or something like that. The thing I thought everybody missed is Palantir's commercial revenue for the U.S. was up something like 100 plus percent. It was up something like 120%. And just, people completely miss that. And there's not a company that's pretty much in this space that you're going to see putting up those sorts of numbers in terms of the United States and growing at those sorts of rates in this industry. Incredible. Company also has over 10% of their stock price just sitting around in cash, which is beautiful, $2 billion plus, and the market cap's like $16 billion right now. So that's pretty darn attractive. Going to cross $2 billion of revenue here very soon, and expect to have 20% plus revenue growth, year after year after year for many years to go in the future, and get to very nice profitability. So looking at a company that has a great product, going to continue to expand their product. The product's going to be extremely sticky, and I think they're going to turn into a cash flow machine and a great profitable company. So yeah, very, very thrilled, and I think the workforce at Palantir is top tier. So Palantir, definitely one I'm excited to continue to build my position in there, okay? Number 6 of these 11 stocks up here is The Honest Company, HNST, needs-based company. They sell diapers, wipes, cosmetics products, beauty products, soaps, shampoos, all those sorts of things. Needs-based company. Stock price already bottomed months ago, and the thing to understand, I think some people don't know this, is when you're in a crash, different stocks bottom at different times. Not all stocks bottom at exactly the same time and then, we're all going to go up. Certain stocks have already bottomed in this market and will not hit new lows. Other stocks still haven't hit their bottoms. Other stocks are hitting their bottom right now and will continue to for the next few trading days and the next few weeks. It's a process that has to work through in the market, okay? Now, when it comes to Honest, they already hit their bottom, months ago, let's call it that. And in terms of this company, by the way, if you're not familiar, and maybe you're familiar, but you're like, Honest, where's this from? This is a company that Jessica Alba started over a decade ago, and she did a great job running it. And now, basically, they have a lot of executives that came over from Clorox over time, and they've just done a really good job just continuing to grow this company. It resonates really well with the millennial generation and the next generation as well. So much better than like the Procter & Gamble's and many of those old school, let's call it, companies do, okay? Now, when it comes to this company, 24 cents EPS loss expected next year. Why is it a big improvement year over year? And by the way, I think they're going to lose way less than that. I think it could even be a break-even year next year for them, in my personal opinion. One is they're going up on pricing. They announced that last quarter. 2, scaling the business. 3, transportation costs are going down. And on top of that, revenues expected to go up very nicely for the company next year. So, been in a tough spot in regards to Honest. They came public pretty much at the end of the FOMO cycle, let's call it, in the market. It was somewhere around, if I recall, May of 2021. So by that point, anything new to the market had already, the market basically topped in February of 2021. So this company just went public at a very bad time. It never was able to build its shareholder base out. It's trading at a 1 price to sales ratio when stocks in this industry traded a 3 to 5 price to sales ratio. So this stock could 3x and not even be overvalued. It could 3x tomorrow. That's the thing. It could 3x tomorrow and not be overvalued. And, in terms of their bottom line, I'm not worried about that at all. That will take care of itself over the next few years, and they'll get to very nice profitability standards, let's call it that. And price to sales, I just think is laughable because they're literally taking market share from their competitors, and their competitors trade at 3x to 5x the price to sales ratio this company does. And if you think they can't ever fix their margins, I just think, it's very misguided because their margins are going to go up dramatically over the next especially as their cosmetics and beauty business builds out. I mean, does it get more profitable than that? Oh my gosh, okay. Alrighty, that was stock number 6 of 11. Let's get into 7 of 11. Oh yeah. This is, let me be very clear, the biggest upside stock I know of in the stock market. And it absolutely comes with risk. It's a big money loser in terms of their bottom line. Obviously, the stock price is highly volatile. It's down 78% year to date. There's no stock I know of in the stock market that has bigger upside potential than this particular stock, Fubo TV. Okay, it has massive long-term and short-term trends. Short-term trends being around football season and then World Cup coming. Long-term trends being around streaming, just getting obviously much, much bigger. People breaking away from cable and things like that. This stock was another one of those that bottomed months ago in regards to Fubo, okay? Now, it's very important. Basically, analysts have this company growing 32% next year. First off, who else is growing 30+% next year? Who? I don't know. Maybe Tesla? That's a maybe. I don't even know. Like that's a real question. Like, who's growing 30+% next year? Hardly anybody. They're the 1% of the 1% of companies in terms of their growth rate expected. But here's the best part. I think analysts are being way too conservative with their revenue numbers, to be quite honest, okay, in regards to this company for 2023. I think they're acquiring way more new customers, and we'll see this over the next couple quarters when they report. I think they're acquiring way more new customers than the company expected to and than analysts expected to. Their retention's unbelievable, so they're going to keep those customers. Upsell opportunities are phenomenal now when you sign up for the service. I've watched how this service has played out over the last year, and I'm really impressed when you sign on now, and like the upsells for this company are tremendous. And you can get a bunch more extra channels for $10 or $15, things like that, okay? And their ad business is a little baby business right now, and that's going to build into a beast. So I'm looking at this company, and although 32% is ridiculous because who else is expected to grow like that in 2023? I think that number is actually low. Okay, I really do. I think they're going to make great strides in terms of their profitability as well. I don't think they have to add a lot of cost to this business now at this point in time, and I think each dollar the company, let's say, brings in now is going to be much more toward that bottom line than obviously previously it was, right? Now, in terms of Google Trends, here's the most recent kind of data over the past 12 months. So, things have gone pretty beast mode recently, right? coming off the summer doldrums for the company over the past month to month and a half. Obviously things have, gone the right way. Let's put it that way. But here's the best part. Over the past Fubo's gotten way more relevant. Dramatic, and this is where I get into, I think over the next couple of quarters, they're going to report much better customer acquisition numbers than the company expected or analysts expected. Because I'm looking at the trends here over the past 5 years, and basically every September, the company always gets a big bump. It's football season, so everybody, signs up for Fubo who maybe hasn't in the past. And if you're a college football fan, NFL fan, like Fubo's the best. Like there's no one you're going to get a better service from than Fubo. Like I as a football fan myself, it's phenomenal. Like for college football, there's so many games on at the same time you want to watch, right? So Fubo has basically something that you can basically through the Apple TV, you can watch 4 games at one time on the TV. So I put 4 games on at one time. For NFL, you can put three things on at once. So sometimes you can put like Red Zone. For people that aren't sports fans, you might not get this and how cool this is, but you can put Red Zone in like 2 games at the same time. So it's like 3 different things, and then you could put like NFL Network for like stats and stuff like that. It's insane, which is like technology that no one else has right now. It's just insane. And so basically the trends have gone ridiculous for this company. And like I said, their retention numbers are always very, very strong. And I think they're going to get probably another nice boost up in potentially November when it's World Cup time as well. So yeah, short term and long term, things are, in my opinion, going to be very, very bright for Fubo. They just have to make it through this, tough kind of cycle of losing money and in a market where no one wants these sorts of stocks. And, the silliest thing about a market like we're in is they throw at everything. And, here we are with a company like Fubo that has some of the most ridiculous growth you'll ever find in any company out there. A business model that's not, like you could spend a few hours just diving into this one and like have a great understanding of where their opportunity is, how they're going to make money, the profitability. If you watch their investor day, it gives you so much good detail on that. Not a rocket science business. Like a Palantir stock like I'm buying, you could be digging for months on that one and still be trying to understand it. It takes a while. Fubo is not massively complicated. Sign up for their service, literally like watch their investor day, and you're going to have a good understanding. It happens quick with a company like Fubo. It's not, let's call it rocket science, okay? Alrighty. Stock number 8 of 11 here, Corsair Gaming. All right, Corsair gaming and streaming hardware play. Obviously, 2022 has been a horrible year for them. I mean, their real problems even started in late 2021. Because basically we came off of not just stimulus, but everybody being forced to be home. People are buying gaming equipment, computer equipment, things like that. And that was a huge trend, right? Well, that obviously broke. But in 2023 and 2024, I think there's going to be a huge boom cycle again based upon the games I'm seeing that are going to be coming out. And things getting, let's call it, a little more back to normal in regards to the gaming space. The stocks extremely hate it. It's a profitable company. It's going to be a much more profitable company in the future, but it kind of got lumped into a little bit of the more speculative stocks because it went public in the last couple of years. And that's silly in my opinion. They shouldn't have done that, but it is what it is, and it's been treated like that. Now, it's a disastrous year for the company. 23 cents of EPS expected. It's horrible for this company. Expect to get back on track in 23 and get up to $1. Horrible revenue this year, obviously. Expected to have down 26.5%. Bounce back year, obviously, and next year expected with 20% plus revenue growth, which I think is definitely a possibility for this company. So, 2022 for Corsair, a year to forget. I'll just be quite honest. It's a year to forget for that company. But in terms of their brands, between the Corsair brand, the Elgato brand, Scuff, which is huge in like custom controllers and things like that, the world is theirs, and they're going to experience, in my opinion, very nice growth in 2023 and in 2024, to be quite honest. This has just been a year to forget for the company, and, it's just been one of those years for them. And it's been like that for a lot of stocks. It's just Corsair's really, really felt it hard in regards to their business model. So that's Corsair. What are we on now? Number 9? It's a lot of stocks, man. Number 9 of 11 that I'm going to be buying in October of 2022 is Google McDougal. So when you get Google, right, which, by the way, Google just crashes through new 52-week low and new 52-week low, and that's why I'm gotten interested in this one so recently, okay? You get Google, you get YouTube, you get their cloud, you get Android, you get their hardware business, plus you're getting more, right? And in regards to Google McDougal, their price-to-sales ratios come down to pretty much the cheapest you've ever seen it at in history. Their PE ratios pretty much come down to the cheapest you've ever seen in history. And their price-to-book has come down to pretty much the cheapest you've ever seen in history, okay, at this point in time. The valuation metrics all across the board are screaming buy Google now at this point in time, okay? Now, in regards to EPS, taking a step back this year, 2023, get back on the right track to growth. And the thing that's interesting with Google is, still a double-digit grower. This company's so massive, so large, you're thinking, gosh, can they really keep growing this business? Yeah. Yeah, they can. And they're just going to continue to kind of knock out those double-digit growth years. And I think the biggest question for Google is, can they ever get back to that 15 to 20% growth rates? And that I'm not so confident in. I feel confident that this company can grow 10 to 12% a year. But, 15 to 20%, if they ever got back there, that would just be a cherry on top for this business model. So Google McDougal, yes, love that one. Number 10 of 11 for stocks here. PayPal. PayPal owns the number 2 and number 3 most popular financial-related apps in the United States of America, PayPal and Venmo. The company's stock price has gotten absolutely hammered. It bottomed quite a bit ago, but still down 56% roughly year to date. It's been absolutely devastated in regards to this company. Great cash flow company, great profitable business model. The valuation metrics across the board are all screaming buy. If you look at price to sales ratio, if you look at forward P, it doesn't matter what you look at, okay? Taking a step back with EPS, like a lot of companies in 2022, expect to get back on the right track in 2023 and potentially have record EPS, which I think is definitely in the realm of possibility. And, this is considered a horrible year for PayPal with 9% growth or so, but that's still 9% growth. Like, that's still decent, right? And expected a reacceleration of growth. Whenever a company goes from basically into a reacceleration, I've always seen it where the stock price performs unbelievably well. So will PayPal be different? Probably not. And 2023 will probably be a very good year for the stock price of PayPal, okay? So love that one. Number 11 of 11 stocks here. You might not have heard this one in a long time on the channel, but the OGs, you remember this one, okay? Because this was a stock I bought, I think it was like $12 or so during Rona, and it went from 12 to 36 really dang quick, okay? Well, stock prices come down a lot recently, and I'm back in the market for this one now, okay? And that is Nordstrom. Yes, department store business plus Nordstrom Rack. They cater to the highest end customers. And I think Nordstrom's been, misunderstood because we've gone from kind of like, everybody's buying things to now people are doing more experiential stuff and those sorts of things, right? Well, keep in mind when it comes to Nordstrom, they sell the products for that experiential stuff. And with people going back to the office more and more, right? And all those sorts of things, business meetings, business trips, guess what? Nordstrom actually benefits from all that. So I think, Wall Street's missed it here with Nordstrom, and they've kind of thrown the stock out because they're like, people aren't buying stuff. No, instead they're going to the concert or they're going, spending all their money on the wedding or vacation, stuff like that. And it's like, yeah, Nordstrom benefits from all that. So I think their business could actually be in a pretty healthy spot in 2023, regardless of kind of what's going on out there. And this one's actually got my attention again. Good old Nordstrom for the first time in a long time. And their EPS is on the right trajectory. Let's just put it that way. And I think those numbers can be definitely hit. Now, in terms of revenue, obviously not an exciting revenue. This is no Fubo TV, okay? Let's just put it that way. But it's a cash flow company, it's a profitable company, and the valuation metrics are extremely compelling in regards to this one. So, hope you guys enjoyed this video as always. Holy smokers, that was no joke. Okay, 11 stocks. Yes, 11 flipping flapjack in stocks. If you're looking to join us in the private stock group, that will be the pinned comment down there to apply to join us in there. Much love as always, and have a great day.